Alright, in this video what I'm going to be doing is taking you through how we show both a commodity tax as well as a commodity subsidy in the supply and demand framework. It's important for students to understand that despite the seemingly rigorous level of technical complexity that we show in terms of our graphs, that the actual underlying concepts themselves are very simple and very straightforward. The theory behind what happens to a market when it's taxed or when it's subsidized is very intuitive and by most accounts could be considered common sense. Now, this doesn't mean that understanding the specific effect is easy or easy to understand, but the actual mechanism, as you'll see in this particular video, is straightforward and, I believe, easy to understand. First, let's start off talking about some basic facts that we know about taxation and subsidization. The first is, it doesn't matter who we specifically tax or subsidize. What I mean by this is that it doesn't matter whether we tax or subsidize consumers, or whether we tax or subsidize producers. The impact of any given tax or any given subsidy will be the same. Second, every commodity tax creates tax revenue and deadweight loss, while every commodity subsidy creates expenditure and deadweight loss. Tax revenue is created because the government taxes a product, and then when the product is sold, this creates money that then is transferred to the government. In the context of a subsidy, instead of revenue being transferred to the government is paying to subsidize a particular product, so this becomes an expenditure. And in both cases of a subsidy or a tax, theoretically, they create deadweight loss. Third, the side of the market that is more burdened by a commodity tax will be the side that is relatively inelastic, meaning that if consumers are less elastic relative to producers, then they will be more burdened by the tax. On the other hand, if producers are less elastic than consumers, then they will be more burdened by the tax. On the subsidy side, since the subsidy is paid for by the government, it doesn't burden sellers or buyers. In fact, they are necessarily better off after a subsidy, although technically society is worse off because of the creation of deadweight loss. Okay, so in this part of the video, what we'll do is we'll actually take you through how we show a tax in the supply and demand framework. Let's suppose that we place a tax on sellers. What this means is that every time a seller sells a particular unit of their product, they then transfer the tax to the government. So when we tax suppliers, how do we show this? Well, the way that we show this is it's essentially a shift of the supply curve back and to the left. Think about the tax as increasing the cost of production to the firm. Prior to the tax, the firm paid to produce their product, and then they sold their product to consumers. After the tax, when the producer sells their product to consumers, they have to give a portion of their proceeds to the government. This increases the cost of production to producers. Therefore, we can show it by shifting the supply curve back and to the left, as shown in the video. When we do this, we create a new equilibrium. We can compare this new equilibrium to the initial equilibrium here at P star and Q star, and then here is our new equilibrium. We see that this is the equilibrium on the original demand curve and on the new after-tax supply curve. This equilibrium will be where the price that consumers pay is created. We see that at this equilibrium, that this is the price that consumers now pay for the product. We also see that this new equilibrium creates the price that producers receive for the product, which we see by P sub sell here. Notice that the price that consumers pay is greater than the price that producers receive for their product, of course with the government getting the tax in the middle. Now recall that the supply curve shifts up exactly by the amount of the tax. So this vertical shift will be equal to the actual amount of the tax, which we also can see here in the difference between the price that the consumer pays and the price that the producer receives. Now, as we mentioned before, every commodity tax creates tax revenue and deadweight loss. The tax revenue is simply equal to the quantity that is consumed and produced after the tax and the tax itself. So if you think about it in the context of just the area of this rectangle, it would be the base of this rectangle, which is the after-tax quantity, times the height of this rectangle, which is the tax itself. Now, the tax also creates deadweight loss, which we see, as always with deadweight loss, is relative to the discrepancy between the initial market equilibrium and the after-tax equilibrium. We also see that the height of the deadweight loss triangle is equal to the size of the tax. That's important to remember. Now, if we move on and we show an equivalent commodity tax, that is a commodity tax that is the exact same amount as the previous tax we showed on suppliers, let's see what happens when we put that tax on buyers. Now, as we would expect, what this causes is the demand curve to shift back into the left. We've now reduced the incentive of consumers to purchase the product. This causes consumers to be less willing to buy the product, and therefore the demand curve shifts back into the left. Notice that this is different than if the price were to simply change due to, say, a shift in the supply curve. In that case, we would simply move along the demand curve to whatever the new equilibrium is. But when we tax the good from the perspective of the consumer, what we've done is we've reduced the value of that product to the consumer. So when the consumer maximizes their utility, they become less willing to buy the product due to the tax. This is why the demand curve shifts back into the left. Now, just as before, when the demand curve shifts back into the left, this creates a new equilibrium. And this new equilibrium creates the price that producers receive. This new equilibrium also creates the price that consumers pay for the product, rather. You'll notice that in both cases, the result is exactly the same. We have an equivalent tax on consumers, and we had an equivalent tax on producers, and the resulting impact was exactly the same. As we mentioned previously, it doesn't matter who we tax in the market, whether it's consumers or producers, the impact is exactly the same. Here, consumers pay a higher price for the product, and producers receive a lower price for the product. Now, in both of these circumstances, the elasticities of the two curves are equivalent. Therefore, the burdens of the tax are equivalent. We will discuss in class how when elasticity is different between the two sides of the market, how this will create disparate burdens as well. But for now, let's just stick with the actual impact of the tax, which we've talked about for the last few minutes. Now, you can think about a subsidy as essentially being the opposite of a tax. Instead of de-incentivizing the consumption or production of a product, a subsidy is going to increase the incentive to consume and produce the product. And we can show it in supply and demand just like we did the tax. And unsurprisingly, if we subsidize the production of a product, this causes a shift of the supply curve out and to the right. We've reduced the cost of production in this case by subsidizing the production of the product. Therefore, this causes a rightward shift of the supply curve. You'll notice, as before with the tax, this creates a new equilibrium. Now, the difference between this equilibrium and the previous equilibrium is that this establishes the price that consumers pay for the product, which you'll notice is now below the initial market equilibrium. Remember that the subsidy does the opposite of a tax. It lowers the price that consumers pay, whereas the tax increases the price that consumers pay. In addition, the subsidy increases the price that producers receive for their product, again, whereas the tax reduces the price that producers receive for their product. And the difference between the price that producers receive for their product and what consumers pay for the product is, of course, equal to the subsidy itself. Now, when the government subsidizes a product, they have to pay to subsidize that particular product, which means that the total expenditure to subsidize a product is going to be equal to the after-tax subsidy, QS, times the amount of the subsidy, or this entire rectangle here that we've labeled as expenditure. Now, just like the tax, the subsidy also creates deadweight loss, and the deadweight loss here is interesting. Normally when we talk about deadweight loss, we've talked about it in the context of price controls or previously in the context of taxes. And in those circumstances, the after-tax equilibrium was less than the previous equilibrium. With the subsidy, however, the inefficiency comes from the fact that the market wanted to consume Q star amount of the good, but the subsidy pushes us to QS, meaning that the subsidy causes the market to produce and consume more of the product than it would have had it not been subsidized. Therefore, this creates deadweight loss. And so while subsidization benefits both consumers and producers, producers receive higher prices than what consumers pay for the product, the fact is that the subsidy still creates deadweight loss because it intervenes in the normal incentive structure of a market. Now, it's a similar story when we subsidize buyers. And as you would expect, if you subsidize buyers, this causes a rightward shift of the demand curve. And the rightward shift of the demand curve creates a new equilibrium. And this new equilibrium is the price that producers receive when they sell their product. And this, of course, also creates the price that buyers pay when they buy the product. And just as before, we see that this creates the same outcome, where the expenditure is just the amount of the product that is consumed after the subsidy times the actual subsidy itself. And we can see that the deadweight loss is the discrepancy between the initial equilibrium quantity and the after subsidy quantity. And we can see that the height of the deadweight loss triangle is equal to the subsidy itself. Okay, so to wrap up this video, I want to say a little bit about optimal policy. If we know how taxes and subsidies affect markets, then this informs us as to what would be good and bad policy in the context of particular policy goals. Public policy always has a goal in mind. We want to tax a product to achieve a particular end. We want to subsidize a product to achieve a particular end. So in this context, we can say a little bit about what would be perhaps good and bad policy. If we tax low elasticity goods, things that are considered necessities, like milk or bread or electricity, this is of course going to generate significant revenue, but the burdens of this tax will be very large, and especially large on low-income individuals. And so, if the goal of a tax is to generate revenue, we may target these low elasticity goods, like say gasoline for example. However, we have to keep in mind this generates large burdens, especially for consumers. Taxing high elasticity goods or luxury goods, like say private jets, are going to create less burden, but of course these taxes will not likely generate much revenue because the goods are highly elastic. And so they're less burdensome, but also less impactful. And then finally, we often tax products because we want to reduce their production and consumption, because we deem this to be a socially beneficial prospect. This is of course true in the context of both cigarettes and alcohol. So we also can tax products because we simply want to reduce their consumption or production. It's important to realize what a tax does. It reduces the incentive to produce and consume a product, and so if we tax a product, we can be reasonably assured that we're going to reduce its production and consumption. With subsidies, if we subsidize low elasticity goods, this is going to be very costly because these are products that are consumed a lot. And so if the government subsidizes products that are consumed a lot, it's going to cost the government a lot of money. However, subsidizing these products may also have large social benefit. In fact, the government does subsidize education highly because of this social benefit. We also can think about subsidizing high elasticity goods, the aforementioned private jets. And these, as we can see, are not likely to generate much social benefit. Lastly, we know that subsidizing products increases their production and consumption. So for those products that which society deems they wish to have an increase in consumption or production, like say flu shots for example, subsidization can improve social welfare, in the same way that a tax, by reducing the consumption of a product we don't think we should be consuming, improves social welfare.